Hi everyone, welcome to this webinar session in which we're going to be doing a demo of the Homecare Cost of Care Toolkit. Thank you all for joining us. I just wanted to quickly make you aware, if you haven't seen already, I'll be putting a link in the chat that this toolkit's freely available on the LGA website, and we're here today with John Campbell and Simon Whitaker from ARCC who developed the tool and granted license to the tool for all councils and providers to use free of charge in partnership with us in LGA and ADASS. So John's just going to run through some of the background behind the tool and some of the frequently asked questions we've already had about utilising the tool, and then we're going to give a bit of a demonstration of how the tool works and what's required. So I'll hand over to you, John.
Thanks a lot, Dan. I'm just going to share my screen. So can I just check? Can you see? Perfect, brilliant. So yeah, good afternoon, everyone. I'm just going to set a little bit of the scene, a little bit of housekeeping, and then I'm going to hand over to Simon to walk through. I'm new to Teams Live, so please forgive me if some of this functionality actually wouldn't be available. But just to make you aware, there's a Q&A function, so please do ask questions, and please do give us feedback. We're gonna walk through it, and we want to try and capture any sort of questions and queries as we go through. So please do post them. You don't have to save them all till the end and then us sort of go back on ourselves. So some context. So we started this work some probably nearly 12 months ago with the LGA. The premise was to support councils and providers to evidence actual costs of delivering care, and that very much is the central premise behind the toolkit. We've utilised the toolkit in a number of forms, and the intention is that it supports that transparency and better working, I think, between providers and commissioners, which ultimately, as we allude to on point 3, should provide some foundations for improvements in commissioning arrangements as well, better understanding of business operating models, etc., and cost, and I suppose is particularly pertinent in the context of the Department of Health and Social Care's market sustainability and fair cost of care, not just from a cost of care exercise perspective, but also from a understanding the market pressures, etc. So we very much started this pre the DHSC work, but obviously it's become, I suppose, even more pertinent as a result of the DHSC's announcements towards the end of last year, and then more recently in the form of the guidance. Some really important points to just note before Simon starts going through the tool. We are advocating the use of actual costs, so this is about working with providers to identify costs of delivering care. We're not advocating a price, and therefore any numbers that Simon will allude to in demoing the model, anything that you see is purely illustrative to bring the model to life. It's not that we are saying, well, it should be this cost for this cost line, etc. And Dan, as he touched upon, will post in the chat and the Q&A the link to the LGA's website, where you can download not only the toolkit but also the guidance document. So what we wanted to do was just say there's a few questions invariably with us doing this for a period of time and engaging with a lot of authorities in the development. There were some frequently asked questions that that people posed to us, some of which I've listed here in relation to how can the toolkit be used to represent a range of scenarios. Is it advocating one price, or what do you do about geography complexity? How do you account for agency staff? How do you account for profit percentage, and who completes the toolkit? These are very common questions, and things that Simon and myself will touch upon as we demo the tool. What I would say is, we very much welcome any other questions. So please don't feel like you have to wait until the end to sort of say, can I ask this? If there's certain questions or things that you want to explore because you've had a play about with the toolkit, you've used the toolkit and you've got this query, do pop them in the chat, because we'll monitor it and I'll feed back to Simon, and Simon can then tailor the demo based on people's understanding and queries that they may have. I'm going to hand over to Simon now to actually take us through the tool. We haven't got a prescribed amount of time, so it depends on in terms of demoing the tool. It will depend on the nature of the questions as we go through, but what we'll certainly do at the end is also then just leave some time to answer some broader general queries, both myself, Simon and Dan, if there's questions relating to the LGA and CHIP and cost of care. So I'll hand over to Simon now.
Just to cover off a couple of things that John had alluded to, we developed this toolkit pre the market sustainability and fair cost of care guidance. So there was really multiple purposes to this, but one of the main purposes was really not just as a data collection tool, but as an analysis tool. And the way that we constructed the model is really to try and reflect how you might construct a budget or a profit and loss, as it were, within a home care business. We've sectioned everything off, so there is quite a lot of detailing here, and anyone that's already downloaded it, anyone that's already distributed it, or started to use it and plug numbers in and do this in their own local areas will know that there's quite a lot of detail. But hopefully today's session and any colleagues that want to join the other two subsequent sessions this month will gather from the session today that there's quite a lot of things that you can probably gather from all sorts of different sources of information, because we wanted to make it as easy to use as possible, but really give the nuance that probably some of the kind of cost of care tools or other approaches might not quite cover off in the same way.
There's one question that we can answer, I think, from the top. So someone asked, can the toolkit be used for housing with care? Has it been tested for this purpose?
Yeah, so it hasn't been tested for the purposes of housing. So there's two separate elements, and probably John's better to answer this than me, but this focuses on the care delivery aspect. So the buildings-based aspect is not covered in this toolkit, but that's not to say that if there are elements that you think relate non-pay costs, so outside of staffing that relate to the care delivery, there is parts in the model to cover that. John, I don't know if you've got anything to add on that.
Yeah, I think just to say, we separately to this tool, we do a lot of cost of care work, and we have utilised the tool for the purposes of things like supported living, where it is about the flexible staff base rather than the building based care. So if in that question what you're asking is not that the care is bound by the housing tenancy, but that there is some, take for instance, extra care or something like that, then what I would say is there is functionality for that flexible care component to be costed. Obviously things like travel time would be a variable that would change, because if it's in a fixed dwelling, then and that'll make a little bit more sense as Simon gone through the model. But yes, there's functionality for where it's staff based rather than building based care, but hopefully that'll become more apparent when we walk through the tool. There was also
So we'll hopefully address some of those things as well, and hopefully give you a bit of a flavour of how we've approached costing for home care. You can see right at the top. So if we're on the tab which is the cost plus home care model. So this is pretty much the meat of the toolkit. This is pretty much where you'll probably spend most of your time. There is a EULA, a license agreement tab, which obviously just is the fact that obviously we've licensed this product for use by the LGA and commissioners and providers. And there are two other tabs at the bottom as well. One is a sensitivity analysis, which we'll go through later, and then finally a data output, which I will go on to later as well. But for the bulk of the session, we're going to focus on this cost plus home care model. A lot of this will be familiar to how other approaches work out. Some of it we might have taken a unique approach, and there might be questions about, okay, how do I fit things in when obviously you're getting information from providers or however you might want to might want to utilise the tool. There is a bit of a legend at the top, so anything that we go through on the model, you can see that anything that's in green will either be a bit of free text, so you can obviously type in here. So we've got visit type 1. I might want to say this is, for argument's sake, a 1 hour visit. I've just added a title to it because I know that the visit length 60 minutes, but you can annotate that. And then other green text might have a drop down, so they might limit your options, but they will have a drop down. So the one over here, and I'll come on to this one in a second, but the one over here has a little drop down, and you can choose different variables by which you affect these numbers below. So some of these green ones have a drop down, some of them are just free text. Anything that's in pink with a red number is editable figures in the model, and these are essentially what drive the unit costs and all of the other calculations in the model. So anything you put in here will drive an output. If I delete everything out, obviously it's completely zero. So the model, once you download it, gives you nothing other than an assumption that there are 52 weeks in a year and 7.5 hours in a full-time equivalent day, for instance. Those are pretty much the only two assumptions that are built into the model. Everything else is driven by what the user enters and the calculation that's derived from that. So that's how the red user input cells and anything else that's not red, white and these summary ones in blue here work. There are also some helpful tips, so you can see, and it gets rather annoying for me because I use this quite a lot, but if you click on individual cells, such as the red ones, you get little tooltips, little explanations here. So hopefully, obviously the guidance is on the website as well, but there is guidance within the toolkit itself. So if you click on anything that's asking you to put something in, hopefully it should help you with what you direct you as to what you should put in. The other bits, the other type of tooltip that we've got in here as well is anything with a red border and this little red comment mark here. So if I hover over that, this just explains what the entire column does, the calculation, so that number of visits per week. And I've got a note about double up calls on there as well, which I'll go through. So these little comment boxes should explain what things mean and what things do, what calculations things have in the model. Just by the way, if you didn't know on Excel, if you're clicking around and these little boxes get in your way, you can click and drag them to the side. So if I drag it up to the side, anywhere else I click, even though the little comment box has changed, it doesn't move it back to next to my cell, so it kind of keeps out of the way, and obviously I don't need to worry about it if it's not in the way then. So that's just a little Excel tip for you. Just a very last note on structure before we dive in. Each section of the model builds up essentially a unit cost for care, and that is an hourly cost as paid by a contact hour, so a face-to-face hour of care. The way that the cost bit is built up is done by different tables in different sections. So obviously you can see here, table A is dedicated to understanding the care hours and the visit breakdown, and you can see the table here, and obviously it gives you a description of what we're asking for in the table. And as you go down the model, each section has its own little title, and then a table which asks for inputs and produces some outputs as well. So hopefully that should give you a good workflow in terms of working through it. Obviously on the face of it, it looks like a lot, but when you get down to it, there's really only a few things that a few critical kind of key variables that the model asks you for. So I'll dive into the first one. So the model considers, rather than traditionally what we might do when we do a cost of care, is we'll look at what's an hour's worth of care worth, and we might say, okay, well, I want to pay there's a direct pay cost straight away. So there's a direct pay cost for a carer. it's well, it would be at least £9.50 now, but let's say it was £9.50. And then everything else that builds up that cost for that hourly unit cost of care is adds on to that by a proportion or some kind of percentage. And we might say, you know, travel time is 10% of that hourly unit rate because I want to add another hour on to pay carers for travel time, and mileage might be another 20 pence for that hour's unit of care. So I'll add 20 pence on. And what you essentially get as a summary is that breakdown of that hourly unit and each of the proportions of cost that go into that. Now, what we've done in our model is we know that businesses don't necessarily operate like that. We operate on an annual basis. We operate on a kind of an annual P&L or a budgetary basis, where we have to take into account the volume of the business, and we have to take into account the volume that the provider is delivering to really understand that distribution of costs, because a provider delivering 1 hour of care is materially different to a provider delivering 40, 50, 60,000 hours of care. And obviously part of that is to do with economies of scale. Part of that is to do with they've got entirely different cost bases, they've got different insurance levels, they've got different things. So not everything scales equally. And the problem with not everything scaling equally when you base a model just on an hourly breakdown is that you don't get a sense of where those differentiators are in terms of what scales, what doesn't, what costs more for larger businesses, for big corporates, what costs more for smaller businesses, and vice versa. So we've built up the model with a view to a single provider delivering from a single branch a volume of contact hours that either the local authority would commission or that a mixture of different customers would commission. So this could be a proportion of this business could come from local authority hours, a proportion of the business could come from self-funders, proportion could come from CHC. If they've got nursing care or complex needs, then you might have a proportion of the business that deliver like that. So the model's agnostic of where the inputs, where the volume comes from. It doesn't necessarily have to be just from a local authority, because it gives you an aggregated unit cost across everything. So it levels off the cost, assuming that we've got the same inputs for different types of work. But we might have different ones, and we'll go through that again in a second. But that's how we build it up. We build it up on an annual basis. And the first question to ask in terms of what does that look like on an annual basis is we need to give the model some sense of how big this business is, so what volume this business is operating with. So the provider here, we've given a visit breakdown, and we can have different visit lengths. So I've got some 60-minute visits in here. And I'm going to say that this provider delivers 250 hour-long visits a week. They deliver 500 30-minute visits a week, and they deliver 400 45-minute visits a week. So I'm assuming that in this model they've got a split of different call lengths. That's important for a couple of reasons. One is it gives us the average visit length and the weighted average visit length across those hours. It helps us contact the hours, but more importantly, it helps us understand the difference between shorter and longer visit lengths in relation to how much time we need to cost in for travel. Because what we would assume is if we're delivering in a local area, let's say that this branch is delivering in one homogeneous geographic region, and it takes, you know, on average the same amount of time to travel from one visit to the next, then what we need to take into account is if they are delivering 800 hours a week and they're only ever delivering 30-minute visits, they have to do a hell of a lot more visits, or they have to do two times the amount of visits to deliver 800 hours in 60-minute visits. So for instance, this business would provide 800 visits at an hour, whereas if they were all to do it in 30-minute visits, they would have to provide 1,600 visits to get to deliver the same amount of hours. Now, when we're looking at unit costs, we would only ever look at one average price, which is you know, whatever that is for an hour's worth of care delivery, whether it's delivered in hour stints or whether it's delivered in 30-minute stints. What the model allows us to do is look at the weighted average, so we get the truly accurate picture of the average unit cost, taking into account that not all of these visits are delivered at one 60-minute length, so that actually the weighted average is 41.7%. What this means is we have to cost in an instance of travel for every 42 minutes of time rather than every hour of time, which actually increases our pay cost that we will accrue for travel. So important consideration there to make in terms of why the model's unique in that respect. So we built up our model here. We're going to deliver 1,150 visits a week, 800 contact hours, and then we've got two other boxes here, which is the travel hours per week and then the travel percentage of total. So in order to fill those boxes in, I need to just go down to the next section, which will fill that in. So the next section is looking at travel time and mileage expenses. And the model is fairly homogeneous in this respect, but I'll talk about how we might vary it for different geographies. In that what we assume is for that mix of visits, for that 1,150 visits or 1,200 visits for cash, 1,200 visits a week, we have to apply a cost for the travel pay for the expenses for mileage. So if we're assuming that everyone is driving a car and we want to pay some expenses for mileage, then we need to put in an average travel distance between all of those visits, and we also need to put in an average travel time per visit as well. And then the last one on this section is the mileage expense, so the pay per mile expense that would be added on top. But just before I go into that one, the average travel time per visit, so we're assuming 5 minutes per visit against 1,200 visits. This basically gives us the breakdown of travel hours we required to be paid per week to deliver that amount of contact hours. And you can see in here, in terms of the breakdown that I've done, because we've got 60 minutes here, 60-minute visits here, and we're delivering 250 hours worth of hour-long visits, the travel hours that we need to pay based on that 250 hours is 21 hours. So we need to accrue another 21 hours worth of pay cost for 250 hours. For the same amount of contact hours per week delivered in 30-minute visits, we actually need to accrue 42 hours worth of travel cost. And you can see that the last column here, in terms of the proportion of total hours that we need to pay, travel makes up 8% of the total in terms of those visits, but it makes up 14% of the total in terms of those visits. And obviously, once you build up your visit types, you build up a picture of the mix of visits within this provider, within this business, you get a mixture of, you get a weighted average. So this 11%. This 11% will give you the travel proportion of costs. Now, in a more rural area, that percentage will be higher. In an area where you deliver on average shorter visits, so if you're delivering 35-minute visits or less than 40-minute visits, that proportion will be higher. So all of these things impact on the cost. You've got to take that into account when you're looking at a unit cost for a provider. So that gives you a little bit of a summary or an identifier around what the travel percentage does. If I just illustrate that, so if I put this up to let's say that this is so it's 5 minutes previously. If I say it's a more rural area, say it's 8 minutes, then obviously you can see that 11% turned to 16%, which obviously makes a material impact, has a material impact on our cost. The other thing that we've put at the bottom as well here which is not something that you can amend, it's just calculated for you, is the average travel speed. So what we're saying is if we're delivering 1,150 visits a week and it takes us 8 minutes to travel 1 mile, then we must be traveling at an average speed of 7.5 miles an hour. Now, that's fairly low. I would never expect it to be, if I'm in an urban area, I would never expect that value to be 30 miles an hour because that's the speed limit, and we can't travel on average at the speed limit because we've got traffic, we've got all this kind of stuff, and I've put that in the little comment box there as well, that we wouldn't ever expect that to happen. But you know, we might expect something like 15-20 miles an hour in an urban area. If we're in a more rural area, we might expect a higher average travel speed. But again, these are all things that you can check and challenge. You know, you can use Google Maps to do to model different trajectories in your areas. This just gives you a helpful breakdown of, if I'm going to model for 8 minutes and 1 mile, then I'm assuming that it takes that my workers are travelling on average 7.5 miles an hour between visits. So it gives you a helpful indicator there. I'll just move that back for the purpose of completeness. But there's but that's just a helpful helpful indicator there. The other thing that you can see that we've got on here is the mileage and travel expenses. So again, to deliver 1,200 visits per week, that actually means that if we're travelling a mile between each visit, then we have to cost in for 60,000 miles per annum to deliver all of those visits. And obviously the cost of 60,000 miles per annum at expenses of 35 pence is 20,930. So it gives us it starts to build up a picture of costs already. The travel pay cost then that's applied to that is also given here, but again that's calculated a little bit further down, so we'll come back to that one. But rather helpfully, we've just done a little bit of a summary, which is the total travel costs already in this model to deliver those 1,200 visits a week is £70,000. So we're going to get to a business that is probably in the order of 6 to 7 figures in terms of its turnover, its revenue, and that's obviously just one portion of it. The next section then, because we've added in some idea around all of the variables in terms of volume, travel and care hours being delivered, the next section is then a summary of we've called it a branch and volume summary. So volume because this shows us the total volume that's going into the model, branch because we've got this little branch calculator down here, and I'll explain how that one works in a second. But the first table in here, there's only one input for this table. Everything else is information presented back to you so that you can see what business, what size of business, what size of provider this is. And what it gives you is a lot of key volume indicators per week, per month and per annum. So you can see that 1,200 visits turns into, we're doing 60,000 visits per annum in this provider. Which translates to direct face-to-face contact hours of 42,000 hours. So per month, that's 3,500 hours. So every business size is different. You know, you can have businesses that will deliver 500 hours a month. You can have businesses that deliver 5,000-6,000 hours a month. Whatever it is in your local area will be determined by the types of providers you've got, your rurality, how you set up your frameworks. You know, if you've got tiered frameworks and you've got main providers, they will typically be a lot bigger. If you've got more spot providers in your area, you might find that the average provider size is smaller. Again, this all has to be driven by what your local area looks like, but it tells you something about what the provider size is. It then adds in the travel hours, and what we get down at the bottom is, and we use this for the to calculate direct pay costs, which is the total contact and travel hours. So we can see here that the total direct pay costs that we need to calculate are based on us delivering 46 or 47,000 hours worth of care and travel time. So that's our kind of key volume indicator for this section. The one bit that the model asks us for in here is the average number of service users. This is used to calculate CQC registration fees, because obviously CQC registration fees in home care are predicated on, there's a branch fee which is fixed, and then there is a fee per service user which is obviously taken at a point in time. But we can use this indicator, this average number of service users, to calculate that CQC fee in the model. So I just put 100 service users in this model, which gives us average service user hours of 8 hours a week. That's probably a little bit small. That's probably a little bit low in terms of average package sizes. I mean, when we do work in local authorities, we can see anything from, on average, anything from between 10 and 20 hours a week in terms of a package size for home care. So probably a little bit on the low side. Nothing in here is to say that it won't happen anywhere, but obviously it just gives you that indicator to say, can you check this back against what you commission, what you buy in the what the market supplies, and does this reflect what you know to be your local area in terms of what packages you provide to service users. So so it gives you that helpful indicator there. The table to the left, to the right of this, sorry, get my left and right the right way around. The table to the right of this is what we called a branch calculator. The reason we've put this in is because what we recognise is that as commissioners are using this model, they're going to want to aggregate costs from all sorts of different providers, and they're going to want to get a view of what the total area looks like in terms of commissioning a volume of hours. So for instance, whilst I put numbers in that are reflective of a single branch, just for ease, and you can see that the total branches required here, say it says 1 at the minute. We know that if we're looking at aggregate costs and we want to figure out what the average might be across these, but also from a commissioning perspective, what we might need in terms of, you know, what might our market need to look like, what might the size of our market need to look like. We added this branch calculator in, and it works in a couple of different ways. Firstly, if you were to model hours for a region, let's say that instead of modeling 800 hours a week, we might want to, I'll quadruple all of these, so I'll put 1,000 in of them, I'll put 2,000 in of them, I'll put 1,600 in of them. Okay, 1,000, a bit too much. Okay, so then we get to in the model, we've got total direct face-to-face hours of 166,000 hours. Now, in my experience, that would be an enormous provider, and I don't know if there is one out there that delivers that kind of hours in terms of a single branch, but they would probably be rare if they did. But that's a pretty big branch, suffice to say. So what we need the model to do, if we're looking at this from a commissioning perspective and from a whole region perspective, the commissioner will commission 166,000 hours, but they know that they will need to do that from multiple branches. So what you can do is you can use this branch calculator to say, well, if I know that the average branch size is going to be X, then how many branches will I need to work out to be able to service this volume of hours that I know I'm going to commission? So in here, you can see that some of them are blank and one of them's highlighted. If I just click this drop down, we can manage the branch capacity by a number of different variables. So if I do it by hours per month, that's the one that it's on, hours per month. Let's say that I think that an average branch is going to do 3,500 hours per month, and just because I know what maths I did upstairs, you know, I know that is then going to tell me that there's 4 branches required to service that amount of volume in this local area. So that's how that works. You put in your branch capacity, it will tell you how many branches required. What that also does is it puts some multiples on the cost when we come further down in the model in terms of the non-pay cost, the overheads. So any fixed overheads that you will have to pay for each branch that you commission care from, then it will multiply that cost against those branches so that you get you know, you get that replicated cost. That unit cost is a true average across your whole environment.
Someone asked the branch calculator table, the pink cell to be completed on the LGA link is service users per branch, not monthly contact hours cell like on this demo.
Yeah, so that's what this drop down is for. So what we recognise is that different providers will describe their volume, their capacity in different ways, and you've actually got 4 different ways that you can do it on here. So for instance, if you wanted to vary it by service users per branch, then you can click service users up here, it will highlight that one, and then the whole model will only ever calculate on service users per branch, not monthly contact hours. I worked in dom care for a couple of years, and we always talked in terms of monthly contact hours, but again, that was us. We, you know, not necessarily do it like that everywhere. I know that other places work out the capacity in different ways, but you can basically change that variable, which is why it will obviously blank out the others. And you can see as I scroll down, I can amend those as needed. So hopefully that answers that. Retravel, we have a mix of walking runs. Can the tool work with this combination? So we haven't kind of disaggregated and separated out drivers versus walkers, and we've been purposefully non-specific about what this travel relates to, what mode of transport this travel relates to. The reason being one because the model's got a level of complexity in it that probably goes further than most other models anyway, but we want to retain that usability, and there's all sorts of layers of things that we considered adding that we said, well, actually in the round 90% or 95% of things are covered, and we think that this will maximise usability. So that's one reason why we didn't kind of say, let's have all sorts of different modes of transport and what proportion of staff will use them. The other more practical question, the other more practical response to that is, whilst you've got a mixture of drivers and walkers and people that will take the bus and things like, some people might have to get, you might have to get taxis. I mean, we've obviously interviewed quite a lot of providers, and some providers actually they do pull car to the start of a village or the start of a run for the whole run. They don't, then the care worker can kind of walk between all of their visits, but then they have to get picked up at the end of the run. So there's all sorts of different ways that home care agencies will manage travel. But what we've been conscious to do is, for every instance of travel, we need to add some kind of expense. And what you typically find is that home care agencies may give an expense to walkers for bus fares, for instance. So that expense, that travel expense, could cover a multitude of things. It could cover buses. Your average travel time per visit, you might want to say, well, actually, I know that in my whole area, I've got 20% of walkers and it takes them twice as long on average. So that therefore you might want to weight your average travel time per visit to say, it takes 5 minutes in a car, it takes 10 minutes for 20% of my people to walk. Therefore, there's a weighting between 5 and 10 minutes to 80% towards drivers that will drive what my average visit time is. So there's ways and means of introducing those types of variables to the model, but I guess the right answer is it doesn't necessarily overtly give you that. So we've gone through the branch summary, we've gone through the volume. The next variable cost that we need to consider in our branch is then PPE. Now, obviously, we developed this model during COVID. We were very conscious that PPE, infection prevention and control was pretty much the norm. We're still very much, for a lot of for a large part of this type of market, for many that aren't in this sector, it's kind of it doesn't really impact their lives, but certainly for this sector, it still has a big impact. And we also know that things like IPC grants, payment for PPE doesn't last forever. So we've added in a PPE calculator to help highlight the impact of PPE costs on delivering care. The way that we develop this calculator is by looking at the unit cost for different types of PPE. So it asks you for unit cost of different types of PPE. Asks you for how many of these items might be required per visit, and then asks you to apply a proportion of all of the visits that this provider might do that will attract that PPE cost. So just to walk that through in a bit slower time. Let's say that we've got our 60,000 visits per year, and every single visit, a care worker has to replenish their face mask, their gloves and their apron, and they have to apply PPE to every single call throughout the year. So what this means is we've got a unit cost of, I don't know, whatever the average of that is, I've just put in as an example, 22 pence. So let's say a PPE cost is 22 pence per visit. So it's per visit, not per hour. 22 pence per visit. Therefore, we have to cost in an extra £13,000 for PPE to deliver this model. Now, you might have, depending on what type of care you're delivering, you can have things like shopping visits where you might not have to have, you certainly wouldn't have gloves and an apron, for instance. You might still have a face mask, obviously, if you're out in the supermarket. But you'll have shopping visits which will have less PPE. You will have different types of visits where you have to do multiple activities which require a change of PPE within the visit. So this is just the average. So if we have, 25% of our visits, we might need to change 2, 3, 4 times, and then 25, 30% of our visits, we don't need to have any PPE at all. It's just asking for the average. So again, it's an estimate of what we think that impact might be. So we're on the last 2 sections of the variable costs, and then we'll move on to overheads and the more kind of fixed costs in the model. And the next one, which is probably the most important one, because this is the thing that drives the money, which is our rate card and our breakdown of costs for our carers. So Now that we've got the volume, what we can do is say, well, I understand that there's probably not going to be a homogeneous carer workforce delivering this activity. And I might find that there is going to be different types of carers delivering different activities. And what we've got in here, and you can see these ones are highlighted in green because you can edit these. So you might not have a carer, you might not have a senior carer, you might have different types of staff in here. But what you can do is you've got 5 different types of staff. There's a couple more fixed ones here, which I'll explain in a second. Different types of staff, and then apply a basic hourly rate to them. And then what you can also do is apply some enhancements. So the model breaks down flat lines hours that might be delivered at weekend over a calendar year and bank holidays over a calendar year. And you can apply an uplift to those basic rates. So you can see in the model here, just an example. I've assumed that the basic rate gets paid on weekdays and weekends, which is those 2 columns. So because obviously I put nothing in for an uplift for weekends, but I've also assumed that 50%, there's a 50% uplift for bank holidays, which is just so happens to be 2.2% of the hours in the business needs to be paid at a 50% uplift. So that breaks down the basic rate. What we then need to do is, based on those 46,500 hours in the model, we need to say, well, how many of these hours will be delivered by a carer? How many will be delivered by a senior carer, etc., etc. The model assumes that 100% is delivered by a carer unless you tell it differently, and you can tell it differently with these percentages here. So I just put in as an example, 10% of all care packages are delivered by a senior carer, and that might be reflective of, I know that 10% of my packages have more acute needs. There's some specialisms there. There's some additional training or something that goes into making a senior carer need to deliver certain types of care. And then I've also put in here something for an enhancement. Which I've obviously just as an idea we've entitled short notice and unsociable. And I've said that let's assume that we can't always get a carer at £9.50 an hour to deliver care, and there will be inevitably people going off sick. There will be inevitably someone that just cannot cover a call or something that's short notice. In order to incentivise those calls to happen, I might need to add some incentives onto a pay rate, or I might need to get some bank. I mean, it very rarely happens in dom care where you use agency, but there may be other enhancements that I need to pay in order to cover some of those calls. So this is really what this line does, and it asks you for an enhanced rate and an indication. And we cover this when we do provider engagement, when we do surveys to fill the cost of care. We ask for these types of things. We say what proportion of cost relates to things that you can't pay at your standard rate, so that we can build up that model. And you can see here that we said 5% of all calls need to be paid at £12.50 as opposed to £9.50. And all of that gives us the total direct pay cost, which is the table underneath, but more importantly, it gives us a weighted contact pound per hour. So you can see this £9.91 is a weighted rate of all of those different variables in the above table. And I come back to what I said at the top of the show in terms of how you normally see a cost of care constructed in dom care is it's an hourly rate, and it starts with what's the direct pay rate for the carer. And the direct pay rate might be the flat, well, it's £8.91, it's £9.50, it's £10. In reality, when we're thinking about this, when we understand how the market operates and what proportion of staff deliver what care, we get a much more accurate weighted contact rate, which will help us with really understanding the kind of the true cost of care. So that's really what drives that part of the model. Non-contact related pay costs. So once we've got all of our direct pay related costs, we then need to add on all of the other things that basically get our carers out on ground to deliver care. And all of these things constitute holiday pay, sick pay, suspension. We might have maternity, paternity. We've added in a line for shift apportionment, which I'll cover off in a second. And then any other additional non-contact pay. Again, there will probably be other costs that providers might say, well, actually, we pay, I don't know, we might pay some other kind of costs that have to add on to our pay rates. But that's why we've added a line for additional pay. The shift apportionment, what we've recognised is that Some providers, it doesn't happen a lot, but some providers do pay for shifts. And in order to understand the cost impact for shifts, we have to assume that there is a proportion of staff time that is not direct care delivery, it's not travelling to and from, it will be in between time. So it might be paying for breaks, it might be paying for, you know, an extra half an hour in the day, particularly when it comes to things like you know, like rapid response type models. If we're looking at something like, I don't know, we want to do a hospital discharge type model where we keep staff, retain staff for some, so that they can respond within 48 hours. We have to recognise that the provider has to put a model in place that means that carers are going to be paid for a shift, and they may not all, that cost may not all be calculated in direct face-to-face and travel. So there's a proportion there for shifts, which is essentially what that covers. In terms of the other pretty standard costs, holiday pay, there is a little tooltip here which I'll bring back into the view, and it's probably tiny as that, given the fact that I'm zoomed in so much, so I'll read it out. But essentially what we're saying is we've put 12.07% in there. Now 12.07% is the proportion that you should use when you're looking at the kind of the statutory minimum holiday days to apply on top of any other hours. So that essentially, if you looked at a full-time equivalent care worker, 12.07% of their time applied on top would equate to 20 days holiday plus 8 days bank holiday per full-time equivalent year. So if we scale that back and add 12.07% onto whether someone's delivering half a full-time equivalent or a full-time equivalent or 3/4, 12.07% will always maintain our statutory minimum. That's not to say that you can't put anything more in, but just a note, if you put something less in there, you might risk not costing in the statutory minimum amount that people have to pay for holiday. I'm also conscious, I'm sure there'll be a comment around the fact that we've got an extra bank holiday this year, which is hence why we made it a variable model so that we can account for differences in things like that. A note on additional contact pay, and then just finally before we move on to training, is we can use this as things like a premium for like agency staff, for instance. So let's say that we know that our direct pay costs are up here, and we you know, we will pay ordinarily £9.50, but let's assume that some of those hours we had to pay for agency, and we had to pay that at, I don't know, 12, 13, 14 pounds an hour. So the differential there between the £9.50 and the £14 an hour will be £4.50. So what you can say is you can add on the portion of that. So if I just do 9.50, I'm just going to do a little calculation in here so that you can see the see the difference here. So basically, if we're going to add on a £4.50 onto every £9.50 pay rate, then that's basically, we have to account for 47% uplift on costs. Now, we're not going to do that for everything. We might do that for 5% of all of our calls. So if we have to add that premium onto 5% of all of our calls, I'll just multiply that by 5%. And then I'll move this little tooltip away. So we know that we've accounted for agency in there at a rate of 2.4% on the whole cost, and that's going to cost us an extra 10.5k.
As PPE is currently free, what costs should be added? As Simon alluded to, there's a couple of approaches here. There's the approach of costing it and then saying, well, actually, if we're providing that, the value of that cost base is obviously the added value in relation to the unit price. The other way, temporarily, if it's completely free, is to keep it essentially zeroed.
Yeah, just put zero on.
Yeah, so you don't need any requirements, and it wouldn't build the cost in. But we wanted to give that flexibility because I think certainly, you know, as that before PPE was made free, there was a sort of scramble around to say, well, what's the cost impact and the volume requirements, etc. So we wanted to keep that in because the landscape's ever changing. So yeah, I'll let Simon talk about training because I think that'll answer the question for attending training cost.
No, it's perfect. Yeah, the astute among you will have noticed that I left training and supervision on for the non-contact, and the reason I did that is because this is calculated slightly differently. So whilst we ask for a percentage proportion on top of hours to calculate for most of the non-contact pay costs, training is slightly different. The reason why we've treated training differently is because training and supervision days, regardless of how often, what a full-time equivalent of a carer is, they should all receive the same amount of training. So if someone works 20 hours a week on average, you would still expect them to get 5 full-time equivalent days of training a year, as opposed to someone who works full-time. Working full-time doesn't mean you need more training. You need the same refresher, you need the same supervision, all of that kind of stuff. So so this is calculated as an FTE days per staff, and you can see obviously the little brackets there tells you that that's what it asks for, and that's the reason why it's not a percentage. If I just delete this one down here, you can see that just putting the number 5 in that box, so I've assumed 5 days per year for training and supervision, just putting the number 5 in that box doesn't actually give us the cost for training. The reason why is because we need to work out how many staff we need for this model, which happens down here in the direct staffing cost, the employers NI, and the pension. And the first ask in this table is this total average care staff per annum. So what we're asking for here is, in order to deliver all of those hours, all of those variable hours above, how many care staff do we actually need? So you can see here that we've got 56,575 hours to deliver. Now that total includes holiday, includes sickness, it includes shift apportionments, it includes maternity pay, it includes everything. Now, if we put in, let's say that there's, I'll put 50 in here for argument's sake. So if we say that 50 staff are going to deliver all of those hours, and you'll note that's changed because we've got training and supervision days that have now been added in. For 50 staff to deliver all of those hours, we can see for the purpose of calculating employers NI, the average number of hours per staff per week is 22.6. And you can see the little thing that I'm hovering over here, the average weekly hours per staff. If you've got 100% of staff are full-time equivalent, then this number should be 37.5, or it should be 40 hours. I know people say that FTE is a different figure. Some say it's 37.5, some say it's 40. It doesn't matter. It's if you're going to assume a model that has 100% full-time equivalent staff, that figure should be whatever it is. The reality is that in home care particularly, not everyone works full-time, so we've got to arrive at a reasonable average of the average hours across everyone. And 50 staff working on average 22.6 hours a week is well, at 50 staff, that's what that gives us. That's not to say that some staff will be working 16 hours a week. There's a lot of staff in dom care that will only go up to 16 hours a week or 12 hours and work no more. Yet there's also others that will do 40, 50 hours a week fairly consistently and just take every shift they can going under the sun. So again, this is really an average, but for the purposes of calculating costs, it only ever needs to be an average, because regardless of whether you work out the variables, if the average is right, the cost will be the same. And what we do is, so we've got 50. So the first thing is we've got 50 staff having to be paid for 5 full-time equivalent days of training a year, which then gives us the training cost there. But this also gives us the employers NI bill for the year as well. So this is obviously the additional cost. So we've got here, and if you remember, we had the weighted contacts pounds per hour here at £9.91. We use that figure up there to calculate what pay rate would be above the threshold and attract E&I, and what would be below the threshold. So this is probably the most complicated aspect of the model in terms of the calculation, but it calculates it as per how E&I is obviously calculated. And the way it does that is it asks you for the threshold, which I believe is it the 1A, part 1A or part 1B employers NI threshold. You can get that from the Gov UK website. I think, well, no, I know this year it's 9,240, and then obviously the liability, which was announced back in October, is 15.05%. So those two figures and the weighted contact costs and the hours per week give us the number of the cost that should attract employers NI. And we know in this model 4.5 hours per staff member per week will go above the threshold to attract employers NI, and then the total cost of that to the provider will be £17,500. The final bit on the variable cost then we've got is pension contributions. So we've got two variables here. Staff opt-out percentage for direct care delivery. So because obviously we've got pension is an active opt-out, so everyone is in until the worker tells you otherwise and wants you to take them out of the pension. We assume that everyone is in, which is why I've set the variable here at 0% opt-out. So I'm assuming in this model that 100% of all staff opt into the pension, and therefore at 3%, which is obviously national minimum, then we get a cost to the employer for the pension contribution. Again, when we do cost of care exercises, we survey providers, we find out what that actual cost is. Most providers don't have 100%. Some do, most don't. They could have anything from 50%, 80, 90% of staff. But you can add that variable in, obviously when you're calculating costs. So that's our employers and our pension. The next section is back office pay costs, and one variable that I should point out before we look at the back office pay costs is this little drop down here in green, which is used for back office pension. So the model has one variable for all of our direct care workforce. So we say we've set pension at 3%, for instance. Let's say that that's what the provider pays. They pay the base minimum for all of their carers. When it comes to back office staff, particularly someone like a registered manager, for instance, or a team leader, there may be an incentive that they get paid more than the statutory minimum pension. You know, they may get paid 4 or 5%. This little variable here allows you to change the percentage for all of your back office staff. So if I just check this and say no, you can see that it opens up this little box here, this manual pension box. So rather than using that 3% figure, if I put 5% in, it will calculate the pension contribution at 5% rather than 3%, and I might put 4% for my team leader. The rest, I might assume, are still at 3%, but because I've obviously asked for it to be done manually, I still need to add that in there. But that's what I'll leave that as it is for now. But that's essentially what that little variable does. Even though you filled something in, if you click it back to yes, it will revert back to this 3%. So you can see the cost change there. So the impact of that 3627, 4651. Okay, so about £1,000 different by give £1,000 difference in the round to give incentives for senior staff in this model. In terms of back office pay costs, we've given a table with some flexibility in here, so you've got some extra columns but extra rows to add in all sorts of different back office staff. You might have marketing, you might have HR, you might have quality, audit, compliance, you might have sales roles, so we might have a business development, an assessor. Assessment officers typically fulfill the role of kind of business development, because obviously they'll go out, particularly when it comes to self-funders, they'll be paid to go out, do assessments, that kind of stuff. So we've added some flexibility in here, but we've also given what we might expect in any traditional home care business to have in terms of their pretty much their core staffing. And obviously we've got a registered manager. We put one full-time equivalent reg manager, a team leader, supervisor in this model. You know, you might have 2, 3, 4 depending on what the provider's information shows. A couple of care coordinators to schedule those 1,200 visits a week. So we're assuming that the productivity of these care schedulers are by definition 600 visits a week that each of them can do. And then administration, finance, ops, we've got a person here on national living wage as well at £9.50. So we asked for the gross pay per hour. It then gives us a full-time equivalent salary cost. We could have done this one of two ways. We just landed on gross pay per hour. Again, this is all about trying to maximise usability and without sacrificing too much flexibility. But we thought it's simple enough. If someone puts £20 an hour, they know that a reg manager should cost £39,000 a year, and you know that's probably something in the round of what a registered manager is for a lot of places. So we know that £20 an hour is reasonable. You know, team leader might be reasonable at 24k, care coordinators, administration. So it gives you an idea of what those gross costs are, calculates the employer's NI as per the variables that we've already put up earlier, and then obviously the pension cost, and gives us the gross cost. This bit here, which you can see all branches, just coming back to that branch calculator that I spoke about previously, this would be where that multiple would come in. So if we had 4 branches to deliver these all of these hours, the direct costs up above would be already calculated because they're all variable. The branch cost applies to, you know, it's one set of these costs per branch. So if we're assuming a bigger volume, or we're modeling for an area, that would multiply those branch costs. But as just to Jess's question earlier, when we divide it back down by the total number of hours, we still get to the same unit cost. So it makes no difference from that perspective. Additional back office pay costs. So there's another table here which would help put in things that aren't necessarily, you know, they're not a full-time equivalent, but they are back office pay type costs. On call is a good example. So you might have additional payments either every quarter, or if you do a little drop down on this, you could do it 4 weekly. So we might say actually it's 200 quid for every 4 weeks, 50 quid a week for on call. And then we've got central staff apportionment. So for larger providers that might have a central staff apportionment, you know, they might have 0.25 of the HR and 0.3 of the finance. And then there's apprenticeship levy, which you'll note is a calculated cell, which I'll come to in a second. Then second to last, we've got all of our non-pay costs and overheads. So you can, just ignoring all of these setup kind of costs here, cells for a second, but just focusing on the tables for the non-pay costs. There's 2 different kind of sections here. One is additional travel related costs. So we've got things like congestion charge, low emission scheme, parking permits. Typically, not every local authority or provider will have these. Few providers will have these. You may find that, you know, particularly London authorities, for instance, there'll be charges for some certain types of these things. Big inner cities, there'll be certain charges for these things. Not in every, certainly not in every local authority, but there's some recognition and some flexibility. If they are material costs that you recognise that need to be costed in, then obviously you can put those in. And then for all of the other typical overheads, we've got, you know, rent rates, utilities, recruitment, DBS costs, third-party training. So assuming that we've covered the direct pay costs for training and taking them out to do supervisions and all of that kind of stuff in our direct pay costs up above, if we need to buy in trainers, if we need to buy in, you know, if we give certificates out, put people on courses, the third-party costs would certainly go into here in terms of overheads. Then, you know, a couple of big hitters, IT and telephony, you know, certainly where you've got ECM, these will be big costs in the business. And then we've got other types of non-pay costs, stationery, insurance, insurance, let me breathe. Insurance, of course, is going to be one that a lot of home care organisations are going to be very cognizant of the cost of that. So I would be surprised if providers couldn't give you that. If not off the top of their head, they could easily put their hands on a letter or something. Marketing, audit and compliance, uniforms, other consumables. Assistive tech, depending on what you're modelling, depending on what type of providers you buy from, if they include assistive tech in the cost and there's some kind of deployment there that's obviously not chargeable because that would be separate because you would pay for that. But if you want to include it in the cost, you can put it in there. And then central head office recharges. And again, we've put in some additional overheads here, so we're not being dictatorial around what overheads go in here. We know that there will always be other things and different ways of expressing these costs. The one thing that we have flexed in the model is this period, so I'll just hover over that, given that it's what I'm going to say anyway. So the drop downs you can pick from weekly, 4 weekly, monthly, annually as well. Oh, I've just noticed a typo. Look at that, it's 3 N's in annually. My mistake. So yeah, so you can choose different periods, and all that will do is you can see here £3,000 per period, which is quarterly. The cost per annum is £12,000. So if I change that to monthly, it'll obviously multiply the cost. So just be very careful when you get information from providers about what periods they're quoting on the costs. You can obviously amend that to suit. Typically, if you're going to do a standard template, send out a cost survey, it's just going to be an annualized cost. So all of these will probably be annual. But you might say, well, look, I need some more information. Can you tell me what your rent is? And say, well, I can give you my rent bill. It's quarterly. You can interpret that the way that however you want, obviously, and that's why we put that flexibility in. Last but not least, CQC registration fees. So the fee calculator that I spoke about earlier is actually over here. You can edit this. So the current fee structure, I believe still, I don't think they've changed this yet, is £239 per branch and £54.30.5 pence. 30.5p per service user, which again is dictated from the costs above, from the number of service users above, which gives us our CQC registration fees and the apprenticeship levy. So I've put in the pay threshold for the apprenticeship levy and the levy percentage as well. Again, that's flexible because that could change at any time, and we don't want the model to only be as good as something materially changes in the ether that means that the cost doesn't calculate. So obviously you can amend the pay thresholds and levies there as well. And then finally, we are finally there, and that's taken us quite a bit longer, but I'm quite pleased that we've been able to tackle some questions as we go along as well. We've got the operating surplus and unit costs. So this model breaks down as follows. Annual costs before profit. So all of the costs within this branch, £835,000. Remember, the whole purposes of this is to create a costed model that reflects whatever the provider will give you in terms of this is my business, this is what it costs. So you can check that against that. Operating profit surplus. Now, this is expressed as a markup, so we're adding 5% onto that cost for the purposes of completing, for the purposes of calculating this profit. So 5% on top of that gives us that in terms of a profit. When it comes to looking at the breakdown, the actual proportion as a percentage of the total cost for profit or operating surplus, if it's a charity, will be lower than 5%, and that's just the difference between a price markup and a net profit margin. That's just a slight difference there, but hopefully you appreciate and understand that. But essentially, once we include profit on top of all of our costs, our total of all of our provider costs is 876,951. So the effective unit cost per care hour for this business is £21.08. And the difference between these is that figure divided by the total number of care hours, which is obviously the unit rate that we would pay for, the unit that we would pay for, which if I scroll right the way up here, which is this direct face-to-face hours, 41,600. So to pay for 41,600 hours, the average cost for each of those hours to be delivered is £21.08. Rather helpfully, you've got the hourly breakdown that I spoke about here. So all the stuff that I said before about this weighted cost, this £9.91, it doesn't look like when you might start with this rather than it being an output, which might say £9.60, £9.70. It's a weighted cost. Travel time tells you proportion breakdown. PPE, you can see, I know John had answered a question around what proportion is that. According to this, it's 1.5%. If we work with those costs. Holiday, 7%. Holiday is one of those areas which is particularly useful in this model because it highlights that actually there is a significant cost in holiday. Yeah, back office again, 15.8%. So it gives you that breakdown at the end and then obviously breaks it back down to that cost per hour. So the data output tab, because the model's locked down and obviously all the calculations are locked down so that you can't inadvertently change anything, we added this tab in so that when people have, if you've completed the model, if you've input all the data into the standard cost model, essentially this just replicates that hourly breakdown. And I believe, if I'm not mistaken, Dan can tell me yes or no, this should reflect what the Annex 3 for the home care cost looks like in the DHSC's cost of care request, isn't it? Tell me yeah or nay. No, okay, he's gone silent. He might have had to nip to do something. So I believe that this cost breakdown is something similar to the oh, it is.
Sorry,
Yeah,
yes. Essentially, this is mirrored in you'll see when you see the DHSC guidance that's been published, and they talk about the format for reporting for the home care cost of care exercise. That essentially that has mirrored what we have here in the data output section. So when councils come to complete those exercises by mid-October, when they're inputting the results to the DHSC template, that'd be very easy to take from this template and transfer over into that template.
Yeah, brilliant. Thank you, Dan. So we put that in there to obviously to make it easy for that Annex 3 return when it comes to your home care, your aggregated cost for home care.